Since 2021, Intel stock is down 63%. They are reporting earnings tomorrow, and in this video, I am going to do an in-depth analysis by looking at their financials, their balance sheet. We are going to compare it with their competition and use my EXO spreadsheet to calculate Intel's intrinsic value. Starting with their income statement and regarding revenue, this company has seen a big drop from an all-time high of $79 billion in 2021 to $56 billion currently. Same story with their net income, from $24 billion to a loss of almost $3 billion. The question with this company is, are they going to get back to what they used to in the past? Because last time they did $56 billion on revenue, they did $10 billion of net income. Therefore, in my opinion, the current net income is an anomaly. And regarding future profit, analysts are expecting this company to make $4.24 per share in 2027, which, if you assign a 15 PE, which is the market average, it would make the company a $63 per share stock. That's doubling in 5 years, which is very good. But again, the question is, can they improve their profit? If we take a look at their competition, AMD is selling at a 7.7 price to sales. Intel, on the other hand, is trading at a 2.4. The price to sales is a great valuation metric to compare stocks that are in the same industry. If you want to compare it also to Nvidia, which is kind of in the same industry, but I wouldn't say they are competition, they are trading at a 43 price to sales. AMD and Nvidia are more expensive. However, they have more growth potential. So the question we need to ask is whether we are overpaying for Nvidia and AMD and underpaying for Intel. Now we are going to use my EXO spreadsheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I am going to do a 7-year analysis and make low, middle, and high assumptions. So let's get and explain the assumptions. Regarding revenue growth, analysts expect this company to make an average of 7% over the next 5 years. So I put 7% on my middle assumptions. On my high, I've put 10% because the chip market is expected to grow 12% from here to 2023. And if Intel is able to be on top of the market again, I think they can definitely achieve that. Then on my low assumptions, I've gone for 3% in case they struggle. Now regarding margins, historically their profit margin has been between 15 and 29%, but it is currently at 12%. I assume that they get back to the margins they used to have, so I went with 12, 17 and 24, because remember that this is an average for the next 7 years. Their free cash flow margin is currently negative, but historically it has been similar to profit margin, so I matched them. Because I believe that if you invest in Intel, you invest because you believe that they are going to turn things around, so my assumptions are based on that. In terms of PE and price to free cash flow, the average of the stock market is around 15, and you should assign a higher PE based on moat and growth. Therefore, if they manage to go 10%, I'm willing to pay a higher multiple, and that is why I put 18. Then on my low assumptions, if they only grow 3%, I'll put 14, and then 16 in the middle. Finally, the discount rate is the return you want to get each year on your investment. And because you can get around 9 or 10% investing in an ETF, if you take the risk of investing in an individual stock, your rate of return should be higher. And also, as your assumptions are less probable, you should put a higher desired return. This is why I went with 15, 13, and 15. According to my EXO spreadsheet, we can conclude that the valuation looks very attractive. But again, I have assumed that they get back to the margins they used to have. And if they manage to do that, this stock has a lot of upside potential, because if my high assumptions occur, you would make a 27 return each year, which is insane. If the middle assumptions occur, you would make 15%, which is very good. And if the low assumptions occur, you would make only 3%. The EXO spreadsheet does not give any value to the balance sheet, so let's quickly take a look at the debt of this company, which is the difference between the market cap and the enterprise value. In this case, it's 22 billion, which is some debt, but nothing that worries me as Intel is a well-established company. In conclusion, I believe Intel is a turnaround play. This means that if you believe the company is going to be able to have the margins they used to have and they are able to compete with Nvidia and AMD, the stock has a lot of upside potential. Disclosure, I don't have any shares of Intel, which doesn't mean you should buy or sell. Please do your own research. I am personally waiting for the stock to fall more, which I think could happen either because the market in general falls or because Intel is going to cut their dividend, which I think can happen because they need that money to grow. I hope you enjoyed the analysis, and I'll see you on the next one.